Good evening. Welcome to the final presentation of our portfolio analysis for the financial modeling assignment in corporate finance. We're Group G from class 11 and 4 in the National School of Business, University of Economics. In our analysis, we'll cover 6 main parts. And to sum up, we will do some analysis of our watch list of 10 stocks and present how we could make a decision to narrow down our watch list from 10 to 5 stocks, which is our portfolios. And finally, we use Excel software to find out how to allocate our initial investment of 1 billion Vietnam dong to these 5 stocks to get a portfolio with the lowest risk as possible. So let's segue into the very first beginning of our analysis, which is about our investment philosophy and methodologies. So any investor would expect to earn the highest return with the lowest risk as a norm, but our investment taste is quite different. We do aim at investment with high returns and low risk, but in case we have to choose between these two, we'd go for the low risk, as shown in our investment philosophy, which is investing with the lowest risk possible. So regarding 10 stocks in our watch list, they were chosen based on 3 key factors, which are their performance in the past, their growing potential in the future, and their performance compared to their peers. And then as part of the requirements, we'll give some comments on each stock risk, return beta coefficients, and regarding the returns, we use the daily returns are assumed to be continuous, so we use the logarithmic approach. And then we use the average and standard deviation function in Excel to calculate the daily returns and multiply them by 250 or square root of 250 to get the yearly results. And regarding the beta coefficients, we use the slope function in Excel with the VN index daily returns as the independent variables. So I think that's enough for the executive summaries. So let's segue into our analysis of 10 stocks in our watch list.
Okay, thanks for your introduction. And here we will get into the business description and some comments about recent return of 10 stock. Firstly, about Candy House Trading and Investment, which was started in 2001 and is on wholesale under ticker KDX in 2010. It has become a prestigious and credible brand name in the real estate market. After 20 years in operation, it's now having 26 subsidiaries and focusing on 4 main segments. And our group has decided to include KDH in our watch list because 2 main projects of KDX in Thủ City are about to be launched, and the next few years are expected to witness a strong fallback as a zero estate cycle. But the recent return, average annual return and standard deviation of KDX from the same period are not outstanding among others in our watch list. This can be explained by 2 reasons. The period 2016 to 2020 is the mid-end of real estate cycle, and the COVID-19 pandemic has hindered the growth of real estate project. And in comparison with others in the real estate segment, it has a higher average annual return and much more healthy volatility. Next. Secondly, about the DG World Corporation, which was established in 1997 and listed on wholesale under the ticker symbol DGW in 2015. After more than 20 years in operation, it has achieved many success, especially in the ICT sector. And our group had decided to include DGW because it had been chosen to be an exclusive distributor of Xiaomi and on cooperation with Apple and Huawei. Moreover, the national lockdown has created a need for home entertainment and online shopping, making DG World become a shining star in the COVID-19 dark sky. About the recent return, average annual return and standard deviation of DGW from 2016 to 2021 outperformed others in our watch list because the period 2016 to 2017 witnessed a sad state of the whole ICT sector, and DGW has stepped up a comfort zone, joining 2 new sectors and become the exclusive distributor of some important partners. And it also has a higher average annual return compared to its biggest competitor, NWG, and also less healthy volatility. Next. So about Hoàng Phát Group is a well-known both as a multi-industry private economic group and a leading position within the steel industry. And it was founded in 1992 and listed on wholesale in 2017 under stock ticker HPG, and it had expanded business line and now operate in 4 main segments. And our group had decided to include because HPG has a unique competitive advantage and proven its dominance in the steel segment. Moreover, HPG has significant potential in the future as several its access, particularly the Dung Quoc Iron and Steel Integrated Complex. About the recent return, average annual return of HPG during the same period is quite high, but standard deviation had the highest position in list, which can be explained by 2 reasons. In 2016 to 2020, HPG has large expenditure on projects that in the investment phase, along with some unstable event in the world. So within the steel segment, its yearly average annual return and standard deviation has outweighed other competitors. Next, about SSA Security Corporation, it was established in 1999 and listed on HNX in 2006, then switched to Hosea in 2007 under stock ticker SSA, and it's positioned itself as a leading financial institution in Vietnam and still maintaining commitment to diversing segment in the core business. And our group is designed to include SSA because it has maintained the number one position in the 7 consecutive years regarding market share for stock during pandemic. With the economic prospect and low interest rate, the 2021 security market will have strong growth and welcome a new class of investor for SSA. And it is still a stock with relative low return and high risk. Those statistics of SSA can be explained for 2 factors: global unstable events and shortage of new catalysts for new domestic market. Within the security market, SSI yearly average return is the second lowest, but it has the lowest risk, indicating a lower bearing risk for investor. Next, founded in 1988 and listed on Hosea under ticker symbol FBT in 2006, it has grown to become the largest IT company in the private sector in Vietnam, operating in 2 business segments. We include FBT in our watch list because we consider this company as a long-term potential investment by seeing a new transition in the technology value chain of FBT. Moreover, COVID-19 is considered by FBT leaders a golden opportunity for digital transformation, as the direct digital investment in transformation is constantly increasing. So with a relative high return in the second lowest stock dispersion, FBT statistic outperform the statistic of all stock on the watch list because there is such demand for this digital transformation in the midst of COVID-19. Therefore, FBT has continued to expand the Make by FBT ecosystem. So despite having a low average return than its competitor, FBT has much lower stock dispersion. So that's the end of my part, and the next part will be analyzed by Hà.
Thank you. I'm Hà, and I will continue his part. Mobile World Investment Corporation is a market leader nationally in retail sales and currently expanded into regional market, which is retail chains at Điện Máy Xanh, Dây Di Động, and Bách Hóa Xanh. The company was founded in 2004 and entered the stock exchange host in 2014. The COVID-19 outbreak has a direct impact on the retail business, but Mobile World managed to survive and achieve a large market share thanks to the strategy of expanding the Điện Máy Xanh Super Mini chain. Additionally, the ongoing Directive 16 in the South region turned out to be a huge opportunity for Mobile World, mainly thanks to the increasing online shopping demand and the stockpiling during the pandemic. Next slide, please. However, Mobile World clearly let these years become a wasted potential because its expected return was only around 23.34% for the period, the lowest in the watch list. The stock dispersion was on a medium level at 31.58%, which is pretty close to the watch list average. The median performance of the Mobile World can be reasoned within 2 events: the boycotting of the consumer against Bách Hóa Xanh price gouging and investor hesitation with the company huge annual bonus share for employee. And in compared to other competitor, Mobile World had a lower return on investment, yet a much healthier volatility. Next slide. Next, Evin Group, the largest conglomerate that had resources invested in multiple sectors, formed in 1993 and the first listed on hold in 2012. Evin Group had a promising growth, primarily thanks to the technology breakthrough and the consumer potential post-COVID-19. The highlight was the app WinShop that attracted more than 11 million WinID members. Additionally, increased urbanization rate, middle-class consumer, alongside recent upgrade in transportation infrastructure, is forecasted to drive the rise of automobile, which benefits the Win Group greatly. Next slide, please. However, the return rate of VIC over the period might not be an exceptional one at 24.5%. Is among the lower half of the watch list and making it safer considering all the factors that affect. Its yearly standard deviation of 28.47% is among the lower half of the watch list, and it makes it more safe consider all factors that affected volatility. The same pattern can be observed in the peer comparison. When Win Group stock is more on the low risk side, this statistic can be explained by 2 reasons. That is a series of favorable events for Win Group since last year and the fast but steady growth of Win Home in the highly competitive real estate sector. Next slide, please. Also, in the real estate industry, fact that Real Estate Development Corporation started its journey in 2004, and 6 years later, it first appeared on Ho Chi Minh Stock Exchange under the ticker PDR, mainly operating in projects in both the luxury resort, large-scale residential area, and civil infrastructure. PDR is showing high competency. Recovery for the real estate industry is expected to come fast due to the low loan rate for housing, stable GDP growth rate, and favorable government policy. And by 2022, the increasing housing demand plus the request for high-class traveling will fully benefit the company since it has many projects of substantial value under construction. As expected, PDR average annual return of the period is 57.67%, the highest among the chosen. Besides, it saw a moderate diversity in the price range at 30% thanks to two reasons: a succession of perfect triumph in the real estate and the announcement of new projects, as well as the digitalization in the company data gathering process. The peer comparison saw a similar pattern when PDR completely outperformed its competitor regarding the average annual return while maintaining a safer volatility. Next slide, please. Another industry that we are interested in the banking industry, specifically the military commercial bank. MBB was established in 1994 and officially listed on the House in 2011. MBB is now considered a reliable, multifunctional financial institution with sustainable development and effective business activity. In the COVID-19 pandemic, MBB still record outstanding performance with a profit of more than 7,000 billion Vietnam dong. To diversify the customer base, the bank had coverage with consulting partner and launched business model as a series of digital applications. Next slide. With an average annual return on MBB around 23% and a fluctuation by 36% per year, the bank had a fair performance. MBB annual return is lower than the average return of the watch list, yet it had a slightly healthier volatility than the rest. In regard to the peer comparison, MBB ranked second regarding average yearly and healthy volatility. The moderate statistics are reasonable, given that the bank supported the debtor enormously in COVID-19 with more than 1,000 billion Vietnam dong, as well as the strong investment into innovation for the company growth. Next slide, please. Alongside MB Bank, we also include Vietcombank on our watch list, formerly known as the Foreign Exchange Department. Founded in 1963, the bank was listed on Host in 2009 under stock ticker VCB. VCB has made important contribution to the development of the country economy as a key external bank. It is now a versatile bank operating in many fields, and it could be no exaggeration to say that if the Vietnamese stock market still exists, then so does VCB. Since VCB is one of the four pillars of the Vietnamese stock market that make up most of the stock capitalization and have significant influence. Besides, the bank has great potential in international market with many overseas operations. Next slide, please. Over the period, the average return on VCB was roughly 20.33% and 29.47% annual standard deviation over the same time period. And despite having the lowest projected return in the watch list, VCB has a much healthier volatility than others, owing to its largest market capitalization, new support for loan policy in COVID, and a strong investment in digitalization. This matches the fact that VCB has a low return, but the most healthy volatility in comparison with other top Vietnamese banks. And after considering the risk and return of our watch list, it will further demonstrate how we select our portfolio from the watch list.
After giving some comments on the recent returns of each 10 securities, we then plotted on them on the recent return scatter plot, and we noticed that there were 5 stocks, which are FPT, KDH, VIC, PDR, and VCB, creating a line that covered the rest. And using a principle of the feasible set, the line represented a trade-off between the high return and the low risk. That's why it was both outwards towards the top left corners. And some argued that no one would choose the VCB and VIC, as they did not lie in the efficient frontiers. But we have to make it clear that it was not about the efficient set or feasible set. What we applied here was their principles. Although VCB and VIC had a lower return compared to those that were not chosen, they had a much more healthy standard deviations, which was suitable with our investment philosophy, which is investing with the lowest risk as possible. So then we choose this 5 stock, FPT, KDH, VSC, and PDR, and VCB. Another step, we assume that these 5 stocks are equally invested with 200 millions on each stock, and it means that each of these stock now makes up 20% of our portfolios. And then we calculate the return risk and beta coefficient of our portfolios. And regarding the return and the beta coefficients of our portfolios, they are simply the weighted sum of each 5 individual stocks, but it's kind of different for the variance of our portfolios. So first we have to use the data analysis tools in Excel to calculate the covariance of each pair of our portfolios. And then we have to use the most functions to get the product of 2 matrices between the weight and the variance tables. So that's how we got a statistic of our portfolios. And for further analysis of our portfolios, we're presented by Kate.
So the beta coefficient will be presented by me. We will present the analysis of KDH, FET, VIC, BDR, VCP from 2016 to 2021. So first is the KDH. The beta coefficient of KDH in the period 2016 to 2021 was 0.64, which means that the return of KDH performed only 64% over those of the market. To illustrate, when the market did well in that period, KDH did less well. This is understandable because our analysis of Vietnamese stock market has shown that the real estate stock usually have a very lengthy accumulation phase before the market phase. Therefore, stock and real estate always lag behind the market to a certain degree, which means they cannot catch up with the volatility of the market. So to the FPT, the FPT beta coefficient was 0.97, indicating that FPT stock were highly connected with the VN stock market. FPT stock performed well when the market did well. This is because with a 12-month or less business cycle, tech companies don't have a lengthy mature time because disruption is always lurking around the corner. Therefore, stock of tech company have a tendency to be relatively close to the market volatility. To the VIC, the beta coefficient for VIC from 2016 to 2021 was 0.93, which is rather close to the market volatility, which means as a whole, if the market performed well, then well so the VIC and vice versa. This can be great news for investors since the report published by Vietnam Report has stated that 2021 will foresee exponential growth for Vietnam stock market. The degree of 0.93 can be somewhat anticipated because the VIC portfolio includes business from different sectors in Vietnam market, from risky real estate industry to the traditionally market reliant of service and entertainment. To the BDR, regarding BDR beta for the period, it is shown as 0.52 compared to VN stock market. This indicates that it showcases less chance when the market occurs by as much as only 50% of its volatility. Perhaps this is because the real estate market tends to be stagnant, with change occurring remarkably behind compared to that of other fast-moving industry. To the VCB beta was 1.2, indicate that VCB stock fluctuated 20% more than the VN stock market in 2016 to 2021. The reason for this could be that VCB is one of the pillars of the Vietnamese stock market. So when the market is up, investors would consider buying this pillar first, and order when the market is down, investors would also consider selling this pillar first. Next, please.
Okay, so now moving on to the market. As we use HOSE as our market portfolio, so we will consider VN index as our price in the market portfolio. First, I want to talk about the return. The market portfolio's annual average return for 2016-2021 is 14.45%, which means for 100 shares that you bought, investors accrued 114.45 each year on average as return. Although mathematically, the return rate is quite inferior compared to all the stocks included in our portfolio. It is already a step up compared to its previous iterations. VN index exploded with a series of numbers that continuously peaked, as well as impressive growth in the market capitalization and liquidity during 2016-2021. Moreover, we do some comparison with the 6 price of the market portfolios within the Asia region, including SCT, Nikkei 225, PSEA, PSEI, SGXL, MSCI, SSEC, and the biggest one in the world currently is S&P 500. The market portfolio's yearly average return has outperformed all the other markets and is at 37% higher than the average of others at around 5.09%. This is partly due to the repetitive volatility in the global market. Foreign investors shift more focus to Vietnam. A high average annual return has illustrated a bright prospect for Vietnam stock market during the same period, as well as rising potential for future. Now, talking about the risk, the annual standard deviation of HOSE from 2016 to 2021 is 18.17%, implying that the annual average return deviated by 18.17% every year from the number of 14.45% compared to each of the securities separately, as well as our portfolio. The market standard deviation is the lowest, indicating a low level of volatility and a small risk for investors during the same period. In contrast, despite the impressive annual average return of HOSE, its standard deviation within the Asia region is slightly higher than the average, 17.59%. This statistic can be attributed to two reasons. First is during the 2016-2020 period, the Vietnam stock market is unpredictably volatile due to the instability event such as the Brexit phenomenon, the winning of Donald Trump's presidency in the US, especially the ambition of China to conquer Asia. Secondly is the emergence of COVID-19 as well as scarcity of fresh catalysts for the domestic market from both domestic and international investors to actively withdraw their cash, resulting in a difficult period for Vietnam stock market. Now, for the beta, if you weight all securities by their market value, then by definition, the resulting portfolio is the market. So a beta of the market portfolio is 1. This indicates that for every 1% movement in the market must move 1%, and individual stocks are ranked according to how much they deviate from the market. Moving on, next slide, please. About the portfolio. First, I want to talk about the return. Portfolio's average annual return, or ARR, are 32.74% of a simply a weighted average on the 5 individual securities in a portfolio. This return is much higher than that of most of the individual stocks in our watch list, and even twofold that of the whole Vietnamese stock market, 32.74% compared to 14.45%. This indicates that even an investor with 1 billion Vietnam dong equity equally invests 200 million Vietnam dongs in FPT, KDH, BIC, PDR, VCB, he would receive 1.3274 billion after a year on average. Our portfolio ARR could reach that high because the stock of PDR reached the record high in 2016, 2021, 57.67%. Now, about the risk, as Tan have mentioned before, we use the matrix approach to calculate the yearly variance and standard deviation of our portfolio rather than using the weighted average approach. First, there's two things I want you to think about is our portfolio standard deviation, 18.36%, is less than the weighted average of the standard deviation of individual security, 27.94%. This result is the implementation of the diversification effect in the real world. As an investor will bear a lower risk when he diversifies his investment among many securities rather than relying on one investment. Compared to each security separately, the portfolio has the healthiest volatility with the lowest standard deviation. Now, our portfolio standard deviation is even very close to that of the whole Vietnamese stock market, 18.17%, which would guarantee a super safe investment for investor. Moving on to my final part, the beta coefficient. Our portfolio's beta coefficient is 0.85. It's simply a weighted sum of the 5 individual securities in our portfolio. The beta 0.85 can interpret that the portfolio's excess return performed 50% worse than the market excess return during up markets and 50% better during down markets. This shows that our portfolio is quite sensitive to the market volatility within the same period. That's the end of my part.
So for the bonus point requirements, so we simply use the Excel solver tools to figure out the appropriate weight of each 5 stocks to get a portfolio with the lowest risk. So first, we also get all the function prepared just like the previous step with when 5 stocks are equally invested. Then we use Excel solver with the objective box is the variance, and the by changing cells is the range containing the weight. And we chose the minimum box set and then set out our assumptions. And assumption was like all the weight are equal or larger than zeros and equal or smaller than 1. And also the sum of all weight is 1. And then we got the results. So this is our portfolios before and after using Excel solvers. So as you can see that the standard deviation is lower, it's like only slightly lower, but the return is much more higher. And also the beta coefficients was also changed by different weights of each 5 stocks. So that's how we got a portfolio with the lowest risk as possible. So I think that's the end for our presentation. So thanks for listening.